Hey guys, have you ever wondered how rich people pay no taxes? Stick around. I will be giving you a clear breakdown of 3 common scenarios on how CEOs pay less in taxes, and I will be showing you how rich people pay no taxes. The image you're looking at lays out a powerful visual comparison of how different forms of compensation, salary, stock, and borrowed money can dramatically affect the amount of tax a CEO pay on $1 million. It highlights a critical distinction between earned income, capital gains, and borrowed funds, each of which is treated differently under the US tax code. Let's take a closer look at each scenario and what it reveals about how income and assets are being taxed. The first one, number 1. The normal tax route, salary, income. This is our first scenario. The normal tax route on salary income. In the first and most conventional scenario, the CEO earns a straight $1 million salary. This is considered ordinary income and is taxed at the highest marginal income tax rate, which for high earners is approximately 40%. This is the standard model for how most people earn and are taxed on their income. Okay, so the income type is salary, the amount earned $1 million, the tax rate 40%, the taxes paid $400,000, the net after taxes is $600,000. This is the least tax efficient path, as salaries are subject to full income tax without any tax deferral or favorable treatment. It's how the average worker is taxed, and it's also the most expensive from a tax perspective. Now let's look at scenario number 2, which is the less tax scenario. Selling stock for capital gains. So this is the less tax scenario. In this second scenario, the CEO is compensated not with a paycheck, but with $1 million in stock, in company stock. This stock might come in the form of stock options or restricted stock units, which are commonly in executive compensation packages. When the CEO later decides to sell the stock, the profit is not taxed as regular income, but as capital gain. Now, capital gains tax is significantly lower than income tax, typically around 25% for high earners, including the net investment income tax. That's a big difference from 40%. So, instead of losing 40% to taxes, the CEO pays only a quarter of the value in taxes. Income type, capital gains via stock sale, value of stock sold, $1 million, capital gains, tax rate 25%, taxes paid $250,000, net after taxes $750,000. This strategy results in a $150,000 tax savings compared to a salary, simply due to how the income is structured and taxed. It rewards holding and selling assets over time rather than earning direct wages. Now let's look at scenario number 3. The no tax strategy, borrowing against stock, which Jeff Bezos and Elon Musk, they're very good at that. The third scenario shows the most tax efficient but also more complex strategy. Here, the CEO holds $1 million worth of company stock but doesn't sell it. Instead, they use that stock as collateral to borrow money from a bank. The CEO then spends his borrowed money just like they would spend a salary. Here's the key. Loans are not considered taxable income under the US tax law. Since the CEO didn't technically earn or sell anything, no tax is triggered. The assets are still intact and no income is reported on paper. Asset held, $1 million in stock. Loan taken, collateralized by stock, $1 million. Income reported, 0. Tax paid, 0. The CEO lives off the borrowed money tax-free and continues to hold onto the appreciating stock. Taxes will only apply if and when the stock is eventually sold, at which point the capital gains tax applies. Until then, the CEO effectively assesses wealth without incurring any taxable income. The bigger picture, how the wealthy minimize taxes. This image offers a clear and compelling illustration of how compensation structure and financial strategy can greatly impact a person's tax burden. When you might see 3 individuals each with $1 million at their disposal, the tax outcomes are vary dramatically depending on how that money is received or assessed. Salary taxed immediately at the highest rate. Stock sale taxed later at a lower rate. Borrowing against stock not taxed at all until a future event. You might want to remember these 3 things. I'll repeat them. Salary are being taxed immediately at a highest rate. Stock sale, they're taxed later at a lower rate. Borrowing against stock, which Jeff Bezos and Elon Musk and others, they're great at that. It's not taxed at all until a future event. It also underscores 2 important principles of the US tax system. Capital gains taxes are only due when an asset is sold, not when it's appreciated. Number 2, debt is not considered income, so borrowing against assets creates a legal way to access money without triggering taxation. These methods are perfectly legal. I repeat, in closing, these methods are perfectly legal and widely used by the ultra wealthy to minimize tax liability while maximizing access to capital. It's a stark reminder that how income is structured can matter more than how it is earned. Okay guys, I hope that you have received something from this video. I hope that you have received some value from this video. Don't forget to subscribe to this channel for more videos like these, and don't forget to click on the thumbs up button to leave us a like. Be on the lookout for our next video when it's uploaded. But until then, stay safe and may God bless all your efforts.